Okay, we're gonna move along a little bit here, and we're going to bypass the entity analysis that's in your book, because we talked about a lot about this, but I'm going to talk about it a little bit more. Slide 25. Sole proprietorships are antiquated. They're dinosaurs because there's unlimited liability for anything done in a sole proprietorship. So the powers have given us single member LLCs. This is fantastic. So all sole proprietors should be single member LLCs, so you get liability protection for your actions being a single member LLC. S corp, yeah.
Does that mean you don't have to get insurance?
You should always, the question was, and it's a very good question, does that mean you don't get insurance? Insurance is important for Murphy's Law and quantum mechanics. We do not have time for physics, for me to be talking about physics, but crap will happen, and that's why you get insurance. The mere fact that you're a single member LLC should not stop you from having insurance. Layering asset protection, LLC and insurance, is better than just having one or nothing. You're better off playing it safe because you want to look like a reasonable person, a reasonable man. And if a reasonable man says, hey, I've got some litigation exposure, you know, somebody could get hurt, something could happen, I'm manufacturing something that could cause you know, somebody to get ill or something like that, you need insurance. Now, there's only one entity that Harold Berman dislikes: C corporations. Now, C corporations are used for large corporations that are publicly traded, and they're extremely valuable for that. But I, for the life of me, cannot figure out why you would want a C corporation to be owning real estate, because there's no long-term capital gains in a C corporation, and there's also double taxation. So why would I want to own a capital appreciating asset, hold it for longer than a year, get this preferential tax treatment, and then all of a sudden have it within a C corporation where it's at a 35% tax rate? The answer is you don't want to be doing that. And yet there's many professional CPAs. I go to a lot of these seminars. You put 100 CPAs in a room, all right, it's a very boring room, okay? It's extremely boring, okay? And I hear a third of them talking about their love affair that they have with C corporations. And I say, well, what do you do with the money that's accumulated in the C corporation and taxed at 35%? How do you get the money out? And they say, well, we loan it to the stockholder. And I said, well, what happens when the stockholder owns $1 million back to a C corporation? You can tell my love affair with C corporations. Okay. Now, we're going to move a little bit forward in the book a little bit, because I want to get to some things that I'm particularly interested in. And I want to go to developer law. Some of you are going to be dealing with developers in your professional career. We're at slide number 43. There was a guy working for Mac McCorston's office, very well known, a law firm in Honolulu. His name is Mickey Rosenthal. And I had a client, and my client was buying a piece of property, and it had 173 separate TMKs. Okay, I know that's unusual. So I call Mickey up and I say, hey, Mickey, how many LLCs are we going to set up? And he says, 173. And so I am so crazy. I'm thinking, how am I going to invent 173 names? Okay, but this is the kind of analysis that you have. And what you see in the developer law is that you see that developers, well, first of all, you never want to be a developer as an individual, because once that D, that scarlet D, is on your forehead, you're a developer for life. Everything you do in real estate is ordinary income, no installment sales. There's a lot of bad things. So developers form entities. You're going to see lots of entities. You're going to see multiple single member LLCs for every time they do a deal. You're going to see that many times what they do is they hold the land and they have another entity, not them many times, do the development. What is a developer? What does a development situation look like? You take 200 acres, you bring bulldozers in. You make streets, you bring in street lights, you pave everything. That's a development. A development is not a 2-acre piece of property that you condominiumize into 3 places and you sell off 2 and you keep 1. That's not a developer. That doesn't walk like, you use the duck theory. It doesn't walk like a developer. It doesn't talk like a developer. It's not a developer. Yes?
Are you suggesting that the IRS will look at it strictly based off of a volume of whatever you're building?
I'm suggesting that it's a fact and circumstance analysis which deals with how many of these have you done? How big improvements are you making? If I own 200 acres, I make no improvements, and I sell my 200 acres into 3 parcels, does that make me a developer? I don't think so. I start bringing bulldozers in, it starts to make me look like a developer. So you start to see this analysis. You also see this analysis. They're going to try and get long-term capital gains down here because this person or entity is passive. They're not doing the development. These guys are doing the development. So they're playing a shell game. They hold the land in an entity passive. They have somebody else do the development. Then when the developer, this guy right here, has a sale, it goes into the client trust account. The client trust account separates the income to the developer and the money that goes to the landholder, who is passive. Long-term capital gains is the design. Whether it works is a fact and circumstance situation. But it's something that you guys should be aware of because this is part of the industry. Foreign bank accounts. So we all know that the Swiss secrecy rules have been broken. We know that this guy from France who worked for the Swiss bank took all this information and he took it back to France, he took it back to England, and it was put all over the world, and now IRS has the names and all this information on Americans that own the Swiss bank accounts. We know the Cayman Islands have caved. We know that the Panamanian Papers, which came from this Panamanian lawyer who was doing all the tricky dick stuff in Panama, setting up dead-end trusts, that all of this has been blown up. There's a thing on the tax return on Schedule B that says, do you have a foreign bank account? If the balance in all your foreign bank accounts, which include brokerage firms, average more at any time more than $10,000, you have to file an FBAR. And the FBAR is filed electronically. It's not part of your tax return. They make it so easy.
What does that mean?
That means that it's a separate input to the Internal Revenue Service, the FBAR information. It's not literally on the tax return. But you have to say that you have filed the FBAR. So this is how people get in trouble. And let me just move a little forward. So the place that I want to go is the FBAR penalties, which are on page 47. You can come up to me after the seminar and I'll be more than happy to help you. Okay, so if your aggregate balance is over $50,000, there's a separate form that's filed, and that's also part of that is on the tax return. But basically what you're doing is you're disclosing all these foreign bank accounts. Well, you got to ask yourself a question. Why do you have a foreign bank account? Now, the other thing is that we just talked, somebody came up to me during the last break and talked about the lawyers setting up dead-end trusts, having people put money in places in order to make people look like they don't have the money, but it's not given to a family member, it's given to the person making this presentation to them. Why would you give money and land to somebody you don't even know? I mean, this is crazy. This is it's fraud. It's asking for fraud. It's not fraud, it's asking for fraud. The new place to do business instead of Switzerland, the state of Nevada. Everybody's using these dead-end trusts coming out of Nevada. I hate it. Why do you need to hide that you own something? And exactly how are you going to hide something that you previously owned? All they have to do is get a title report and see that you owned it, and then now this dead-end trust owns it. What are you hiding? So I have a story to tell about FBAR penalties. And I'm telling you this story in order to highlight types of defenses. What I mean by types of defenses, there's basically 3 or 4 types of legal defenses that are used, and I need you to know them in order to cover your ass. So a woman comes to me, and who's my client, and she was from a northern European country, and she's a genius. She married a nice Jewish boy here on Maui. She's a genius. Okay. And she tells me the story that over the summer, she had gone to New York City and hired Harvey as her tax attorney, and my eyes are rolling, and she made a mea culpa on all the FBAR lack of disclosures that she had made over the last 10 years. And she had basically disclosed all of this very incriminating information. But there was extenuating circumstances. Her mother had died. In Europe, it wasn't England, in Europe, it sometimes takes 3-4 years to clear up estates. There was a piece of property that was sold. She thought it was in her mother's name in Spain. There's a lot of extenuating circumstances in this matter. Harvey didn't believe in extenuating circumstances. Harvey believed in the legal theory of falling on your sword. Just fall on your sword. I did it. Take me away. You can tell I do not like this legal theory. This would not be something that who's got a creative mind, who thinks out of the box, who believes in marketing, who believes in packaging. This is not a tool in my tool chest. So he basically pleads guilty, throws himself on the mercy of the court. It cost my client $250,000. So what are the other legal theories? Let's start with the legal theory of plausible denial. It wasn't me. I wasn't there. I didn't do it. I have a younger sister. What a pain in the ass, my younger sister. I was always in trouble. If there was a fight in the family, there was 4 of us siblings. I was one of the 2 people in the fight, and my sister was infuriating. My mother would come to me, why did you do this? Why did you do that? Mom, I've been misidentified. My intent has been misconstrued. I wasn't there. I didn't do it. That's plausible denial. And the thing about plausible denial is, if you say it enough times, you start believing it. It's so beautiful. I didn't do it. I didn't do it. I didn't do it. Okay. Another legal theory that everyone should recognize is the reasonable man theory. You must always be a reasonable man. A reasonable man or person is judged based on your education, who you are, okay, what you supposedly did, etc. Everyone in this room as a professional and online has to act as a reasonable man. When you start doing something and your central nervous system says, it's not a reasonable man wouldn't do this, the answer is, don't do it. If you can't defend everything you do on the reasonable person rule, don't be doing the stuff that's unreasonable. You're only going to get in trouble. You're only going to self-destruct. You're only doing things that are going to come back and bite you in the rear end. So don't do it. And then there's the theory of extenuating circumstances. Okay, I did it. Okay, I did it. But man, there was a lot of extenuating circumstances. And then you get into equitable arguments about what was happening to you at that time, where your brain was, how you tried to be a reasonable man to the best of your person, a reasonable person to the best of your ability, but circumstances were out of control, and that's why the deed was done. But you did everything you could to be a reasonable person. And leading back to my client and the $250,000 because Harvey fell on his sword, okay? It wasn't his sword. He threw his client on the sword because he didn't look at the extenuating circumstances. Now, it was really beautiful when this guy, Chemo Stone, came to talk, because he talked about what it was like to be a defense lawyer for real estate people. And I was shocked. So let's talk about me talking to real estate professionals, since I'm the one talking right now, and then I'll try and be Chemo for a few minutes. I'll talk about me first. I have 2 daughters in their 20s. And of course, they're into electronic communication. And everyone in this room and everybody's watching in line is all into electronic communication. It's part of your daily life, and it's important, and I do not deny its importance. Facebook, LinkedIn, communication, marketing, emails, texts. It's a way of life. Cell phones, all part of marketing. I'm not changing that for you. What I am telling you, though, is before you hit the send button, that you ask yourself the following question. Could what I just said, or about to say, what I'm about to say in this electronic communication that I'm sending out into the air that never disappears from the universe, you know I love that, right? Something that's being said in writing that never disappears, could it come back and bite me in the ass? And if it could come back and bite you in the ass, you better change what you're saying. Not that you shouldn't say things, but you should not say something that puts you at risk. So I'm all about what's in your files that you shouldn't be saying. I'm all about disclosing price points. I'm all about dual agency, and you might be treating somebody in the dual agency, the seller or the buyer, in a preferential way. You could be deemed to not be neutral. And what the hell is dual agency anyway? You spend your whole career being an advocate on behalf of a buyer or a seller. There's a dual agency. You're supposed to take your 2 hands. You're supposed to tie it behind your back. You're supposed to act completely different. And what are you exactly? You're an information gatherer, communicator. Exactly what are you in dual agency? So the number one thing you got to watch out for is dual agency. It's a prescription for professional disaster. Okay, now I'm Chemo Stone. Watch the facial change. It's just amazing how I do this. So Chemo comes in, and he starts talking about what he's afraid of. Well, Chemo's afraid of something I wasn't even thinking about. I was always worried about what you actually put in writing. Chemo was afraid of what you didn't put in your file. He wasn't afraid of what was in the file. He was afraid of what wasn't in the file. So what did he start talking about? Clients lie. Oh my God, what a unique thought. Okay, that clients could lie. What a unique thought that if the price goes up, the seller thinks you sold them down the tubes. What is so unique about the thought that if the price goes down, that the buyer thinks you sold them down the river? And then they claim that you told them nothing. You told them nothing, zero. You didn't call them, you didn't write them, you didn't talk to them, you told them nothing. That's what Chemo is worried about. So he brings out the dual agency agreement. Okay, he starts talking, okay, has everybody got their pens? I go, yeah, I got my pen, man, I'm ready. And he starts, okay, circle this, disclosure, circle that sucker. And then go down to services and circle that while you're reading it to your client. So you're reading the disclaimer, you're reading the disclosure, you're reading the services that you're going to provide, you're reading the various important parts of this dual agency agreement. And meanwhile, while you're reading it, you are circling and underlining what you are saying to your client. Then you send them a blank, a blank dual disclosure. But here's the key. You send them a copy of your circled and underlined disclosure agreement saying, as per our conversation, these are the things that we discussed. And I'm going, this guy's a genius. This is genius stuff. He's talking about what should be in the file. I've been spending all my time talking about what should not be in the file. And he's saying, look, the person says you never called them. But wait a minute. I got this information. See my email? See my email? So if you use email and you use texting and you use electronic communication to defend yourself, man, you're right up my alley. Cover your ass 101. So then he goes to, what do you think he's going to do next? He goes to the seller disclosure agreement, right? Oh my God, do we not have enough problems? The seller disclosure agreement is probably, I got my own thing about dual agency, but the seller disclosure agreement in the industry is a huge problem. The seller doesn't want to disclose something. We'll get to it in a minute. So what does Chemo do? He's got me circling. He's got me, you can't see this, but here it is. Here's me taking Chemo's thing. Circles, underline, 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 while I'm talking to my client about their obligation to disclose. Their obligation to disclose any defects in this sale. And then we get the issue of, near the end under section R, we got this thing called brokerage firms, services, and disclaimers. So he's got me circling the whole thing. I got highlights, I got stars, okay? And then you send it to your client, as well as a blank one for them to fill out, and you say, this is what we discussed. So we went over the seller disclosure agreement. You got all your circles, the bells and whistles, and you got a file. The thing is, you should have a file for every transaction, and the file should have your communication with your client, and you should not send anything, and now I'm back to Harold Berman, okay? You shouldn't send anything that's tricky, that's got an issue to it, that's got a problem to it. And then Chemo starts talking. You know I'm in love, right? Go to your Cover Your Ass 101. And Chemo brings out problem number 3, okay? That's on your Cover Your Ass 101. So here's a property. It's in McKenna. You got a full price cash offer in escrow, $15 million. That's good, right? Everybody can do the math, right? Right? We can all do the math, right? $450,000 of commissions. One thing real estate people are geniuses at is figuring what 3 or 6% of a number is. They're really good at that on the calculator. That's like automatic. Okay, so now we go out and we look at the property and we notice that there's cracks in the stucco and that the floor tiles are cracked. So we might have some settlement of earth. We might have some issues that are greater than the house settling. So I'm in this class and I'm sitting right over here and I'm put in a group, and everybody in my group, there's 4 people in the group, the other 3 people is, I'm backing out, I'm not doing it. And I'm going, are you crazy? There's $450,000 of commission. Everybody in the room was ready to run from this example. I say no. I'm calling a meeting. I believe in charisma. I believe in my ability to tell this. Oh, the seller wants to just paint it over. He wants to paint it over, okay? So we know what the seller's thinking. He's going to do a patch job, and he's not going to disclose in the seller disclosure agreement anything about this. Well, what are we going to get sued for? Has anybody read their malpractice insurance? Okay. 1, it doesn't cover any of your own transactions. 2, it doesn't cover fraud or misrepresentation. What are you going to get sued for? Fraud and misrepresentation. What's fraud and misrepresentation? Misrepresentation. You make a mistake. You make a mistake, an honest mistake. I thought the value of the property was $450,000. Let's use another number, $1 million. I thought the value was $1 million, an honest mistake. Okay? That you have an issue of misrepresentation. I purposely did something that I knew was wrong. I made statements that I knew was wrong. That's fraud. And the reason that fraud is so difficult to prove is somebody's got to be able to go in your head and figure out what your intent is. Does plausible denial ring a bell here as far as your defense? Okay, so in reference to this, everybody in the room, and I mean if there was 35 people in the room, 34 people were ready to run from the seller, except for me. $450,000 of commissions, just let me in the room with my client. I want a meeting with the client and his lawyer. I want to explain to them what it would look like if I back out of this transaction. What is, oh, by the way, the seller has no money. The seller's got to sell this. And if they don't sell it within the 60 days, they're going to be bankrupt and bop, 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 bop. You know, there's always these stories. So what? We should misrepresent so you get sued for $50 million later on? I mean, is there any sense in that? No. Let's figure out if we have a problem. Let's bring a structural engineer onto the property. Let's look at the cracks. Let's see what they come from. Let's see if we can fix it. We got $15 million in cash ready to go. What are we walking away from this transaction? But we have to be a professional. What would a reasonable person do? They go to the lawyer and the client and they try to convince them to do the right thing. Okay, eventually you might have to back out, but you have to fight for the transaction, right? You have to fight for the right, the Beastie Boys. I'm going back a little bit. You have to fight for the right to party, okay? And that's what we got to do here. We got to fight for the right to party. We got to defend our professionalism. If you run without taking reasonable steps, I say you're harming the seller. I say if you don't do the right thing as a professional here, which is to stay in as long as you can, you're harming the seller, because if you back out, what is the buyer's agent going to think? What is he going to tell? Hey, Berman backed out of this transaction. There's something that stinks in Denmark, and I mean Hamlet and Shakespearean stink. So there are messages that get given that are actual messages that are verbally submitted, and there's stuff that just by your own actions themselves speak volumes. And this is what I learned from this seminar that I took. And we were talking before the seminar even began, and I was saying, this is a hard gig, this giving of seminars. I started this seminar almost a year and a half ago. There's a guy in my office, a CPA, his name is Mark Knipp. I gave this to Mark, I said, write this seminar. And he wrote it, and I looked at it, and I was asleep in 10 minutes. It was the worst, most boring seminar. So I decided I was going to do it, make it personal. I was going to make this really personal so you can feel the issues. So I hired Beth Holiday, and those of you who don't know Beth Holiday, she's a very well-known speaker here on Maui. And Beth, I would send her a copy of this thing, and she'd say, "Oh, Harold, it doesn't flow. Oh, and you can hear the bullwhip after every sentence. Oh, Harold, it doesn't connect. Oh, Harold, it's like electron. Yeah, I was being electrocuted, man. And oh, Harold, it doesn't make it. So then I write another draft. So you write 10 drafts, okay? You write 10 drafts, and you go to the Real Estate Commission. So I go to the Real Estate Commission in Honolulu, and those of you who have never been to the Real Estate Commission in Honolulu, it's a really pretty room, and they have this huge desk. There's 14 people around the desk, and then there's 2 seats for the hot seats, and then they have people in the gallery. So they have like 3 rows of galleries. So they call me up, and I sit down, and you know, I put a lot of work in this. I flew over because I wanted them to meet me. And the first woman, it's amazing. Every person on the Real Estate Commission had read every word I wrote. They all knew what's in your book. It's amazing. I was like flabbergasted because I figured they just thumbed through it. Do we want to give a tax class to our real estate people? And we have to hand it to them. They okayed the forbidden fruit being brought to you today. So the first woman to speak, I loved her. I loved her. I loved her. She says, "Harold, it flowed. It connected." And I'm like cracking up. And then the next person said, "Harold, you can't spell." Yeah, I know that. So we were talking about my going to Berkeley Law School. It's a very good law school, and I was there for a couple months, and I got brought into a professor's a room, and he says to me, "Harold, how did you get into Berkeley Law School?" And I said, "What do you mean?" He says, "Well, you can't spell." And I said, "Of course I can't spell." And he said, "And you can't write?" I said, "Of course I can't write." And he said, and then I told him, "I turned down Harvard to go here." And he fell on the floor. He gets back up. He said, "Well, with what skill set did you get into this law school?" I said, "Well, you know, bring 9 other people into this room and give us something to argue about, and I'll blow the other 9 people out of the room, and we'll be done with it, and you'll figure it out." So one person on the commission challenged my spelling ability, and I'm cracking up because I've heard it my whole life, and I can't spell, and I can't write, and so they're going around and they were questioning the font, you know, and I'm going, "The font? Okay, I'll change the font. Okay, I'll change the font." So, but they had read everything, and they okayed this seminar, and they okayed this presentation on the basis that they felt you were ready for this information. So going to my, in the middle of the night, questions that I would ask myself, there was actually a client of mine sitting in the first seminar that I gave back in January, and he's actually sitting in your seat. And if I gave you his name, everybody would know him. He's a client of mine, and he says to me, this is his question: "Harold, I have a genius for a tax preparer." So that's a good start, man. He says, but I took your tax return to a loan broker, And the loan broker looked at your tax return and they said, well, your net income's too low. And so what are we going to do, Harold? What am I going to do, Harold? Because I have your tax return that beat the hell out of the tax liability, and now my taxable income is too low to get this loan. I go, hey, Bob, you're trying to get your cake and eat it too. So I don't understand we had a sponsor for today that was a loan broker, and she's explaining to you non-documented loans. Okay, let's be real about non-documented loans. We had the savings and loan crisis, then followed up by 2008, September 2008, meltdown of our economy because they were handing out money like it was candy. They were giving loans, undocumented loans. People were fraudulently presenting tax returns that were non-existent. And miraculously, when there was a downturn in the economy, it all fell apart. So they were packaging these bogus subprime loans and selling them as securities in the stock market. Oh my God. Okay, so is it a surprise that the industry is under scrutiny? Is it surprise to us that you have to be careful about what's submitted to get a loan? Is it a surprise that they have to be more careful? I thought the woman was slightly evasive that a non-documented loan was going to be creating a much larger interest rate. And undocumented loans without tax returns are an iffy thing. And why are they even doing it now, says Harold, while I'm listening to this woman. And then she starts talking about using your bank accounts to get loans rather than tax returns. And I'm thinking, well, wait a minute. You're giving bank accounts. Okay, the Federal Reserve System. Now we're on a whole different subject. The Federal Reserve System. They can report to the government without the government, the IRS doesn't need a subpoena. You get audited, they say, I want to see your bank accounts. What are you going to say? No? They can get it with a subpoena, so you give it to them. And what are they looking for? What's the number one way that you can go to jail with the IRS? Non-reporting of income. Absolutely. And hopefully you didn't say that from experience.
They have all this extra money with the dispensaries, and they're going to have to do something with it.
You're talking about marijuana? You're talking about marijuana? Hold that thought just for a minute. Okay, she's talking about commercial marijuana and the fact that it's cash economy. Okay, so what happens? They grab your bank account, and the first thing they do is add up all the deposits, right? That took them, now it doesn't take very long. They add up all the deposits, and then they look at your tax return, and do the deposits correlate to the tax return? So you have a business, okay? The business reports a gross income of $100,000, and you have $250,000 of deposits. Hey man, we could have a problem potentially. Okay, we have non-income deposits. Non-income deposits, loans. Could have gotten a $150,000 loan. I could have gotten a gift of $150,000. But if you don't think, let me put it a different way. If you think that you could have an audit and not have to explain the deposits that are made in the Federal Reserve System, you got another thing coming. It's the number one thing. They are salivating looking for non-income non-declaration of income. This is how they hang people. This is how they get credit at work for being a killer, a born killer, and how they get, and that's how that guy with the gun is now running the Maui Collection Division. This is how they get their yayas. There's nothing that gives a revenue agent more of a yaya and a thrill than finding undisclosed income. They're looking for it. And the number one thing that you have to do playing defense, cover your ass 101, is never make a deposit to the Federal Reserve System that you cannot explain. So they're talking about, I'm going to use the broker, the loan broker. I'm going to use your rental income. So just show some rental income. Just deposit some cash and show some rental income. Where the hell logic is that? Creating income that doesn't exist, it's reverse logic. Creating income that doesn't exist, okay? Cash deposits. Where's the rental agreement? Where's the room? Where's the rental property? There's reality here. Now, what this beautiful young lady is talking about is something completely different. We have issues in the United States of America in that there are certain states, the states of Colorado, started in Colorado, now includes the state of Washington, the state of Oregon, in which we have recreational marijuana that's become legal on a state level. We have federal law that says it's a Class 1 narcotic. A Class 1 narcotic means there's no medical. Look at the ridiculousness of the situation. A Class 1 narcotic is the same. In the Class 1 narcotics is heroin. Okay, so marijuana is considered on the same narcotic level as heroin, and it has no medical benefit. And yet the VA, the Veteran Administration, is studying marijuana as a way to treat post-traumatic stress disorder. Then we have Colorado. You guys want to have a kick? There's a program called High Profits, H-I-G-H Profits. It's out of Breckenridge, Colorado, and it's a documentary about this guy who I thought was very interesting, and his girlfriend, who had a recreational marijuana business in downtown Breckenridge, and they were taking in between $30,000 to $50,000 of cash a day. A day. And if you can't use the banking system because it's under federal jurisdictions, you can't use the banking system. So let me tell you what's happening in Colorado. You cannot find a warehouse for rent. They all have lights. They're all hydroponically growing commercial marijuana, and they're okay. So I'm at this seminar in January here in Maui, and like I said, 100 CPAs, and it's a very boring room. But there's a group of us during the break that are looking. Some guy mentions that HCNS, which has 36,000 acres of land, is no longer going to be producing and harvesting sugarcane. So the question became, what do you think they're going to do on 36,000 acres of land? And I immediately think ganja. They're going to grow ganja. But here's some of the problems. You can't ship the ganja to California. You can't ship it across state lines. Interstate commerce, federal law, a stage 1 narcotic. So what are they thinking? So California is going to go next, depending on who's president of the United States. California will go next. A couple of years later, we're going to have it here in Hawaii. And what do you think is going to happen? Well, one thing that's going to happen is there's going to be growing in two ways. There's going to be growing out in the open with security. That's going to be really interesting. Helicopters are really good security. Then you're going to have warehouses in Kahului, in which there's going to be lights and hydroponics. But they can't. Okay, are you aiding and abetting a Class 1 narcotic by renting your property that was a warehouse in the business park to somebody that's going to be growing recreational marijuana on Maui if it becomes legal? Here it is. Ready? I'm going to teach you a really cute circle. Renting is a passive activity under the law. Therefore, I'm not aiding and abetting anything. I'm a landlord, and I'm renting my property. Now, let's try and get insurance. Okay? Because now I have some growing going on in my warehouse. Will my insurance company cover it? This is coming. Okay, we talked about 5 years from now, aiding and abetting by not issuing 1099s. Now I'm talking about 5 years from now that we may have recreational marijuana, both in California and here in Hawaii. What's that going to look like? There's going to be outdoor growing, and it's all in the smoke. It's going to be like wine. You're going to have gallo, and you're going to have top-end smoke. And obviously there's going to be a difference in price. And you're going to follow it from seed or clone to the marketplace.
But as a CPA, thinking out of the box, since these people cannot put it in a Federal Reserve Bank because it's
Yeah.
not legal, what are they gonna do with all of that money?
Well, you go look at this show that I told you about. You go look at the show that I told you about, High Profits, and you look at what this guy did in Breckenridge. The answer is that you can't, is that you declare all your income. There's lots of shots of them going in and paying their taxes. You know, there was like 27% tax or something like that in Colorado on the sales tax of recreational marijuana. They were taking tons of cash to pay the taxes and getting receipts. So you're going to work like a cash economy. It's going to be like before banks. You're going to be getting receipts. You're going to be paying people by cash. You're going to be issuing 1099s and W-2s. Okay, you're going to be doing all those things. Just because the banks don't cooperate doesn't make it that you are somehow get a free pass from acting like a normal business in the United States of America. You're going to have to report all your income. That's the number one rule.
Is it true that they're getting such high taxes that everyone in Colorado is gonna have health insurance?
Well, the question, it's a good question, is it true that in Colorado everyone's going to get a lot of perks from the sales tax? Well, let's look at it this way. I don't know whether first of all, we have Obamacare, so it shouldn't be an issue at all. Number two is, I think there's going to be I don't think there's going to be a deficit in the budget in Colorado. I think their schooling system will be better. I think there's a lot of good things that are going to happen. And look, I've said to you that I don't want you, until it's legal, okay? I don't want you drinking and driving. That's illegal. You're going to get in trouble doing that. And I don't want you puffing on the ganja, okay? Now, when it's legal, we can have a different kind of conversation. But I think that those are the issues that we face. And certainly from a state, it's like having a state lottery. Okay, they had these state lotteries. Now all the money was in there. It's like, it's going to be appealing just from the monetary ramifications of having this be legal. And you're going to see some of the byproducts, not just in commercial real estate, but you're going to see people buying more Hawaii real estate because they can come here and get high. Okay, that's going to happen, and you're going to see more secondary residences, which is why you have to have the people that represent you defend the deduction of interest on your secondary residences on Schedule A, which is your itemized deductions. This is all tied together, covering your ass, seeing how the tax returns work.
Harold, if you're a commercial landlord and you rent to the dispensaries, then are you in danger federally of aiding and abetting?
Well, I think I addressed it. The issue was if you're the landlord and you're commercially renting to the person that's got the recreational marijuana business, the commercial marijuana business, are you aiding and abetting the distribution of a Class 1 narcotic on a federal level? I think it's way too early to tell. I think that we have to watch what happens in Colorado. I do think in trying to look into the future, I don't get it. We took a course, Jeff and I were in this course, and there's this character. Oh my God, this guy's like whacked, and he was teaching ethics. Okay, he's this whacked out guy. He comes every year, and he spoke for 2 hours, ethics. And the whole 2 hours, he talked about the legalization of marijuana and the effects, the ethics issue that it has on, one, the distribution site, the distillery, 2, the grower, 3, the accountant, 4, the landlord. I didn't get it. If you're I personally and professionally didn't get it. If you're declaring all your income, and that's what this is all about. This is not about ganja. This is about the issue of declaring all your income. Every penny. You go into an audit. Most audits, particularly field audits, There's two types of audits. There's a field audit. They get a guy, literally, physical person. He comes. You deal with that physical person. There's mail-in audits, which are 10 times as many audits. They come from Huntsville, New York. They come from Cincinnati. It's all by mail. Field auditors, they come in. They spend half of the audit on income. One number. One number. They spend half of their time on this one number. So if you're playing defense, cover your ass 101, and they're salivating about this one number, you better make sure that that one number is protected no matter what the cost is in income taxes. You do not want the exposure of not declaring your income tax. That is tax fraud, and you can wind up doing time. And there's no amount of money that's worth doing time. Your life is ruined. You're monetarily destroyed. You might be family destroyed. It could destroy your life. What value is there of doing this? So someone comes in my office and they say, "Oh, Harold, I do these side jobs and I show $10,000 of income." And I say to him, "Well, you have a bank account?" And he says, "Yeah, I have a bank account." I said, "If I added how much money went in your bank account, what would it add up to be?" $50,000, the guy says. I said, "Are you freaking kidding me? You show $10,000 gross and you have $50,000 deposited in the Federal Reserve System?" So this is the kind of exposure that you don't want to have. So in my first, Kevin's the videographer. We did this videography of the first seminar, and there was 12 minutes that we had to reshoot because I lost control of the audience. And I spent so he comes to my office up in Makwan. We're videoing this thing, and Roz is outside. She's the timer, and she's giving me the signals. I don't know one of these signals. She's giving this and that, and I'm going, "Oh my God, I don't know what's going on." I spent the whole 12 minutes talking about cover your ass. The whole 12 minutes. I talked about covering your ass on your tax return, not allowing any number. You have to read your own tax return. Before you sign the e-file release, you have to look and see if there's any number that calls out to you, particularly multiple zeros. But any number that comes out to you. You have a side business, you developed some kind of import-export business. You got $2,000 of income and you got $40,000 of travel. Give me a break. You're going to sign that? You're going to sign that return? I'm not going to sign it as the preparer. Why would you sign it as the taxpayer? So look at every number that's on your tax return. Use the tax system as a tax tool for you and your clients. We talked about these red lights. We talked about using these red lights to get your client to a professional. Make sure that your files are good. We talked about Chemo Stone. We talked about the lessons of Chemo Stone. Okay, he's talking from great amount of knowledge, and he's talking about what should be in your files. I'm talking about what shouldn't be in your files. Don't disclose anything in your communication electronically that could come back and bite you. We talked about the issues of sending out 1099s. Those 1099s are a must, and they're going to be a bigger issue as we go forward. This thing is just starting. This is like a tsunami wave, and we're just seeing the fact that, oh my God, the water is starting to recede. We could have a problem here because the wave hasn't come yet. We're just seeing the backlash of the water receding towards the wave. So be ready for the wave. Issue the 1099s. And in looking at representing your clients, we talked about accumulated depreciation as an issue to be thinking about. 1031 exchanges. Many people have taken 1031 exchange classes. That's the one tax course that everyone has had at least access to. Starker, reverse Starkers. Be aware of that. And I want you to walk away with a degree of sophistication. And I want to leave you with a thought. Think about what a balance sheet looks like. Basically, a balance sheet is one day in time, and it shows what your net worth is. And it starts out with assets. What are assets? They're your resources, and they're listed in order of liquidity. So the first asset is cash. The next asset is brokerage accounts. The next asset is whatever can be liquefied easily. The last asset that's usually shown is real estate. The problem, the only negative about real estate that I can figure out is that it's an illiquid asset. It takes a long time to turn this asset into cash. Think about your professionalism. Your professionalism is to move, if you represent the seller, he's moving something from the bottom of his asset division of net worth, and he's moving it to cash. He's moving up the ladder. If you represent a buyer, he's moving down the ladder. He's turning his liquidity into the buying of real estate. You are at the center of the movement of balance sheet net worth analysis on behalf of your client, moving it up and down the ladder of liquidity. This is your place in the economy. It is a gift that you have been given to be a professional in this field, to use your people skills, your marketing skills, your ability to communicate, and to be able to help people liquefy an asset or buy an asset that's a very important asset to them. You know, I developed this class because I wanted to give back. It's been a privilege to be here today. It was a privilege to give this seminar and this course, and I want to thank all of you for being here today. Thank you.